Hi everyone, welcome to the first conversation. And today we have Neha Agarwal with us. She is a chartered accountant and she's also a founder of Masterbrains Consulting, which is closing the gaps of B2B outsourcing with the professional community. This platform helps professionals in the field of finance, tax, and law, and it helps them to outsource the domain work all across the country to experts. Prior to this, she has also worked with the GST team of Deloitte in Bangalore and 5 years in income tax litigation and advisory. Hi, Neha, and welcome to the episode. Is there anything that I've missed about Master Brains that you want to add on to before we get started into the discussion of tax and investments?
Nitish, and a very warm welcome to all the viewers as well. Talking about Master Brains, yes. So, to give you a good news, we have just started a new branch where we'll be doing mutual fund distribution as well. For the expansion parts, we started with B2B and now we are also giving an all service solution, professional solution to corporates directly, where our entire network of chartered accountants, lawyers, valuers, company secretaries would be providing an all service professional one platform to our taxpayers.
That's amazing. And let's take a deeper dive into our conversation today. As you all know, we are almost about to close the financial year. So we decided, why don't we have some discussion over the new tax regime, the new capital gain taxes, and all those that have been introduced in the last year or so, and how can our listeners benefit out of this and gain some insights into what they can do before the end of the financial year. Over the past year, Neha, we have seen there have been several tax changes. So that there has been shift from old tax regime to new tax regime, which would get implemented soon. We have seen changes in capital gain rates and all those changes along with the new income tax bill that's coming up as well. Can you elaborate a little bit on these changes and specifically what implications these can have for our investors?
So, to tell you a little bit about why new tax regime was introduced. So, new tax regime was introduced with the thought process of giving a lot of freedom to our taxpayers and investors to think for themselves and invest. And of course, to avoid all these scrupulous deductions that were being claimed. And yes, as you said, there have been various tax amendments other than the new tax regime also. Last year only, there has been a significant change in capital gain taxation. Both these changes, bringing in the new tax regime and the new capital gain taxation, has impacted the way Indians used to invest. पहले हम invest करते थे for tax saving instruments and tax saving investments, but now we have the entire freedom to invest wherever we want. About capital gain amendments in 2024 and proposed in 25, flat 12.5% tax rate on long term capital gain has been fixed for transfer on or after 23rd July 2024. However, in case of debt, non-equity mutual funds, and unlisted bonds, gain continues to be charged at slab rate only. So whatever your slab rate is accordingly. And for transfers taking place on or after 24th July, the short-term capital gain is taxed at 20%, which has been increased from 15%. However, again, in case of debt, non-equity mutual funds, unlisted assets like real estate or physical gold or foreign equities, etc., gain continues to be charged at slab rate. So last year, there has been change in STT rates. It has been increased on sale of futures and options. It says a lot about the government policies and their view towards future and options. I have not seen even one client of mine in the last 5 years where they have made any profits in futures and options. So the government is also seeing the same and they are discouraging it. The benefit of adjusting the purchase price, that is the inflation, also called indexation, has been removed for all long-term assets with effect from 3rd July 2024. But they have kept a small temporary benefit for immovable property, where there's an option to select indexation with 20% tax rate, that is the higher tax rate, or no indexation with 12.5% tax rate. So instead of actually making it simpler, the immovable property capital gain taxation for long-term asset has become even more complicated. But I think it's a small term thing. It's a short term thing, and it would be simpler in the future. So to classify a capital asset as short term or long term, to decide the tax rates that are applicable on them, we have to see the holding period of the asset. So there has been a change in the holding period also. Earlier it was categorized into 12 months, 24 months, 36 months. It has now been streamlined to 12 months for listed securities, equity oriented mutual funds, units of business trusts, and 24 months for all other assets like debt oriented mutual funds or unlisted shares, unlisted bonds, jewelry, immovable property, etc. Moreover, investors can now enjoy tax free LTCG or equity investments up to 1.25 lakhs instead of 1 lakh. So this was a very welcome amendment that came last year, and this is irrespective of your tax regime. आप new regime में हो या old regime में हो, कोई फर्क नहीं पड़ेगा. If you are making LTCG on equity investments, you can claim that 1.25 lakh of tax benefit. So, in my opinion, these changes will eventually push taxpayers to a more varied portfolio where they would invest in various types of investments on the basis of their return and risk appetite. Instead of just thinking tax saving करना है, तो वो tax saving वाले instrument. And I think, frankly, it would also reduce the cash component in immovable property transactions and, of course, discouraging FNO.
I think those are some great points that you mentioned. And like you mentioned at the end, I think we also used to see a lot of people towards the end of the financial year into February and March coming and saying we need to invest in tax saving because we have this much money that is allowed under the tax regime. And I think that would now get split at the right time and over the year. So that should help investors stay invested for the long term, and as well as not just invest to save the taxes. It would actually make it to be a more investment friendly and purpose driven investment rather than just tax driven investments.
Right. In fact, the change in tax rate on long-term investments is with this view only that the investors should stay in any kind of investment for long. The government is trying to encourage that behavior.
No, I think we have also seen this now because if you would have seen the data for last couple of months in the last year or so is that a lot of foreign investors have been selling out, whereas the domestic investors through the mutual fund route have continued to invest money, and they have been resilient in terms of investing money and not just pulling out as soon as it was within the tax period and all. Coming to the next part of this, is there any other tax benefits or say advantages for investors if they invest in say government bonds or sovereign gold bonds or other assets other than just equities?
Okay, so talking a little bit about sovereign gold bonds, comparatively a newer way to invest in gold without actually buying and storing that in your home or locker. Taxpayers are receiving an annual interest of about 2.5% right now, and it would be taxable as per your slab rate. So, if the bonds are held until maturity, that is 8 years, the capital gain are fully exempt from tax. And if they are sold before maturity, but of course, after the 5 year lock in only, there's a 5 year lock in on these bonds. You can sell them after that 5 year only. And if you sell after 5 year but before 8 years of maturity, gains are taxed as per whatever relevant LTCG rate is applicable at that time. The indexation benefit on SGB is not available after July 2024. And in my opinion, it is generally considered as a tax efficient way of investing in gold. Talking about government bonds, so let's say like RBI bonds, taxpayer will receive interest, which is again taxable as per the income tax slab rate, which is relevant in that year. And just like SGBs, government bonds also, if they are held till maturity, there are no capital gains. And if sold before maturity, it is taxed as per whatever your relevant holding period is, long term or short term. It is generally considered as a low risk investment.
So I think there are a couple of benefits that these bonds have over investing in still a liquid asset, say like gold ETFs or something like that. So obviously you have that 2.5% additional interest component on top of the price appreciation of gold. It comes with some redemption disadvantages over gold ETFs.
Absolutely. But the thing with various types of investments or low risk investments is that the investor has to judge what their risk appetite is. And then they have to manage their portfolio accordingly. They should have some low risk investments also, and they should have some medium risk or high risk investments also, depending on how they want to maintain their risk appetite and how much surplus money they have, I think.
No, that makes total sense. And I think diversification of not just your investment, but also your risk matters because you're diversifying over the tenure of your investment horizon. So short term have something that could be fairly quick to get liquidated and everything. Whereas gold bonds you can hold for a longer period and have tax advantages.
Absolutely sharing my personal experience. So, SGBs actually hedged my portfolio at the time when the market was falling.
It has done well in the last couple of months, especially since September. The other thing that we wanted to know is that you mentioned that tax saving investments are not relevant under the new tax regime. However, since we are already in the month of March and there are many investors who might still be in the old tax regime, what do you recommend for them? Is there any available tax saving options that they still have under, say, ATC, ATD, or any other deductions that I might not know?
Okay, so before I start elaborating on various deductions available, just a pro tip that old regime for salary taxpayers will only be attractive for financial year 24-25 if you have at least 3.5 lakhs of deduction, including the below deductions that I'm going to talk about, your LTA, your HRA. So all the deductions added together should be at least 3.5 lakhs. Then only maybe old regime would be attractive to you. You should always compare between old regime and new regime what is more beneficial. Moreover, I would like to break the myth here that if I choose new regime, I would lose all the tax benefits on my previous investments. That is not the case. So to discuss a few popular deductions under the old regime. Investor can claim up to 1.5 lakh as deduction under Section 80C as per the actual investment made during the year for PPF, ELSS, NSC, Sukanya Samriddhi, life insurance, simple payment of home loan, etc. And the other popular section is ETD, which is for health insurance premium paid during the year for self, spouse, children, up to 25,000 and up to 50,000 for senior citizens, of course, and another 25,000 for your parents, or up to 50,000 if they are senior citizens, and 5K for your preventative health checkup. तो ऐसे जैसे कोई भी लैब से हम लोग डायग्नोस्टिक टेस्ट कराते हैं, that comes under this, and we can claim up to 5,000 rupees included in the overall limit. Then there is Section 80CCD that gives an additional deduction of up to 50,000 for contribution to NBS. Again, my personal view over here, I do not find it a very attractive investment for myself at least. Then we have saving account interest income deduction in 80TTA, which is up to 10,000 rupees. Deposit interest income deduction in 80TTB for senior citizens up to 50,000. In case of a home loan, an SSC can claim a deduction under Section 24B also for the interest paid on the home loan up to the maximum of 2 lakh rupees for a self-occupied property, while the entire interest amount is deductible for a let out, a rented property. Of course, there are other deductions also, like for education loan or donation to charitable institutions and political parties, etc. But those are not related to the investment part. So, for taxpayers filing under the old tax regime, March is the last opportunity to optimize your tax savings by leveraging these deductions. A pro tip here also. So, all these deductions are actual based. They are not to be claimed arbitrarily. Income tax department knows more about you than you know today. You should always consult your tax advisor before choosing your regime or whenever you plan on any significant transaction or investment, and be aware of the laws applicable to you. Be aware. That is the most important part.
No, I think those are very helpful, especially the point I would re-emphasize that you mentioned that as a rule of thumb, at least the deductions need to be 3.5 lakhs for it to be beneficial under the old tax regime. And I think you highlighted this point in your initial discussion about taxes on unlisted shares, private equity. But just to emphasize a little bit more on that, like we discussed about listed space and some deductions under ATC. But can you highlight some of the tax implications for some of the things that have emerged in the last 4 5 years significantly? which has been, say, investment categories such as like unlisted shares, private equity, cryptocurrency, REITs, and all those things. So, can you highlight some of the tax around that?
Okay, so unlisted shares and private equity go hand in hand. They are very similar to each other, and their taxation aspect is also similar. So there's capital gain when we sell these shares, there's dividend income by holding these shares. I'll talk about both of these aspects one by one. So if the unlisted shares or private equity are held for less than 24 months, the gains are treated as short term and are taxed at slab rates. However, if they are held for more than 24 months, gains are treated as long term and they are taxed at 12.5% without indexation. Of course, over 1.25 lakh benefit. Dividend income from unlisted shares or private equity are taxable in the hands of the investor under the head income from other sources at whatever applicable slab rate is there. Additionally, a TDS of 10% may also apply if the dividend exceeds 5,000 in a financial year. With the company TDS काट के dividend आपको देगी. The important consideration here is valuation for these shares. The fair market value is determined as per Rule 11 UA of the income tax rule, which is crucial for calculating capital gains. You may need to hire an approved valuer for this purpose. Talking a little bit about the most talked about asset these days, virtual digital asset. So, cryptocurrency is also classified as a VDA under Income Tax Act. It is taxed at flat 30% rate plus applicable cess and surcharge if it is. And no deductions are allowed except the cost of acquisition and no indexation benefit. 1% TDS may also be applicable on the transfer of cryptocurrencies if the transaction value exceeds 50,000 or 10,000 in certain cases in a financial year. And any losses from cryptocurrency or other VDAs cannot be set off against any other income and they can only be carried forward to set off against VDA income in the future. Receiving cryptocurrency as a gift, it may attract tax in the hands of the recipient depending on the value and relationship with the giver. As now, VDA is also a movable property under section 56(2)(10 of the income tax, which talks about gift taxation. Real estate investment trust, a very interesting topic, I would say. So, REITs are required to distribute at least 90% of their income to the investors. These distributions are taxable in the hands of the investor as dividend income as well as capital gain. Okay, so dividend, of course, if you're receiving any dividend, it is taxable under other sources, and TDS of 10% is deducted by REITs on such distributions, and it is taxed at slab rate only as it is part of your income from other sources. And capital gain can be short term or long term. Again, short term capital gain less than 24 months if you have held it. So applicable slab rate, and more than 24 months, again 12.5% without indexation over and above 1.25 lakhs. I think REITs are still not a very popular investment in India, but they may become one in the near future.
Yeah, I think they are growing. A lot of companies are looking at having their REIT portfolios. And I think as an investor as well, I think when you can't invest in a whole real estate property, I think REIT gives you a good benefit of having some exposure to it. So, and you get dividend, like you mentioned, 90% gains is paid out as dividends. So I think those help investors consider it. So yeah, I think those were very helpful insights that you shared with us. I think we have shared a lot of technical terms and a lot of high profile, say, tax codes and everything with our investors. So hopefully they're able to understand all of it and they're able to get some benefit out of this discussion. If they need to contact you, what would be the best way to get them connected to Master Brains?
Yes, you can always DM us on social media or you can write to us at masterbrains.office@gmail.com. We are always available. We are very quick on our feet um, and reply to the queries very quickly.
And just for investors, if you need any investment advice, investment consulting, you can reach out to Navara Investments as well. Thank you all for listening, and hopefully that this insight was helpful to you.
Thanks, Nitish, for having me.